Welcome to Live Better Longer. I'm your host, Bill Borton. My guest this week is Scott Inglis, who's a Regional Director and Portfolio Manager for Carnegie Investment Counsel. A chartered financial analyst, Scott began his career at DuPont, helping to manage the international equity portfolio for DuPont's pension fund. Scott, welcome to Live Better Longer.
Thank you, Bill. Pleasure to be here.
Yeah. So Scott, everybody wants to know what's going to happen with the economy, and I know you're omniscient, so fill us in.
Well, omniscience aside, Bill, I can tell you that what the facts are, and the facts are the economy is doing terrific. The consumer makes up about 3/4 of the U.S. economy, and that's the first place anybody should look for signs of economic health. And from things like the Michigan Consumer Confidence Survey, which is up near 100, levels we haven't seen since the 1990s.
Really?
We're seeing things, of course, the unemployment rate, recently the number came in at 3.8%, which is a new cycle low and a level that we haven't seen again for quite some time. We can look at things like, in addition to that, the Housing Affordability Index is at multi-decade highs, so housing affordability hasn't been so good in quite a long time. So employed consumers, confident in consumers, a low interest rate environment, a lot of people employed. We really like the backdrop for the economy on the consumer side. Then you look at the tax cuts that just came into place in 2018 and provides a terrific backdrop for corporations and corporate profits. So we're looking ahead at the next 2 years for corporate profits to advance by 25% over the next 2 years. So healthy corporations, healthy consumers, adds up to a pretty robust and positive economic outlook. I don't know that we'll be able to achieve sustainable growth at 3% again for 2018, but we're pushing it. Levels that we haven't seen again since before the financial crisis.
So no recession on the horizon, at least not in the near term?
Not on the horizon, not in the near term. We'd have to look out to late 2019, late 2020 before we'd have concerns about an economic recession.
Now, it's expected that the Fed's going to tweak interest rates up again today, and we've seen several rises at this point. And I know 30-year mortgage interest rates have been inching up.
Yes.
Which could have an impact on new homes. But what do you see in the rising interest rate environment as far as how that's going to affect the markets?
Great question, and the interest rate increases that we're expecting are still forecast to be 3. So where are we now? Let's look at where are we now. We're at 1.75% target on the Fed funds, expected to go higher by 25 basis points, and then 2 more times still. It's very important to understand the financial markets to look at where interest rates are across the curve, not just at the very short end, but across the curve. As you pointed out, mortgage interest rates have inched higher. They're priced off of the 10-year U.S. Treasury, which is right around 3% right now.
Right.
Looking out at 5 years, we're looking at 2.5% Treasury rates. So from 5 years to 10 years, you only go up 0.5%. Looking out 30 years, we're at about 3.1%.
So the yield curve's very flat.
Very flat. A very flat yield curve. And with the Federal Reserve looking to increase interest rates, say at 25% a clip 3 more times, it's going to get flatter. What does that mean for consumers? Again, you pointed out housing. We don't expect mortgage interest rates to move up to a point that it crimps housing affordability. Remember I said housing affordability is at multi-decade lows. That's based on house prices, that's based on average earnings of the home buyer, and interest rates are a factor. But interest rates, even if they move up by 25 or 50 basis points, 1/4 or 0.5% from here, that won't be enough to, in our view, to dampen the enthusiasm for housing. So even interest rates moving higher here it's actually a sign, Bill, that the economy is healthy enough to take it. So if we contrast this with Japan or in Europe, where interest rates have stayed low for a long time, in Japan they haven't been able to raise short-term interest rates the way the Federal Reserve is now in over 20 years.
Well, they had negative interest rates for a while in Japan, didn't they?
They had negative. They still have negative interest rates, and parts of their curve On the short end, they have not moved the interest rate below zero. But interest rates have remained at close to zero now for over 20 years in Japan. That's a sign of economic weakness. So the fact that the Federal Reserve, we hope to see that they raise interest rates today because that's further indication that the economy can take it.
So when you take a look at the markets, we think about stock or equity markets and the bond markets. So everybody's been talking about how overheated the stock market's been, and are there any bargains to be had? I know I've been kind of trying to keep some of my powder dry to wait for the downturn to be able to take advantage of that. But do you see that there are still values to be had in the equity markets?
Sure, and I mentioned corporate earnings growth of over 25% over the next 2 years. In the first quarter alone, corporate earnings grew by over 20%. So, and we have a pro-cyclical view on the economy. So for sure, there are bargains to be had. But, I'd like to if you don't mind, look at what's happened with bonds again.
Sure.
Because if people are going to do something, they're going to have to decide, am I going to own bonds or am I going to own stocks? From 1945 to 1980, about a 35-year period, bonds went from the 2-3% level up to a high of 16%. If viewers could picture, a mountain, a steep mountain that it was symmetrical on each side. From 1945 to 1980, we had a steep climb of interest rates to a peak. And from 1980 to 2015, early 2016, so a 35-year slope on the other side, we had a long, steady decrease in interest rates to a low level of 1.3%. If you remember back when oil prices in early 2016 hit $25 a barrel, at that time, interest rates were very low, 1.3% on the 10-year. So since then, what we've seen is 10-year interest rates have moved from 1.3% up to 3.1%. So an almost 2% increase in 10-year Treasury yields. What has that meant for bonds and bond prices?
Scott, I want to know about that, as I know our viewers do, but we need to take a break for a word from our sponsors. This is Bill Borton. We'll be back in a moment with more Live Better Longer and Scott Inglis.
Hi, I'm Christine Patton, the Juice Girl. The Champion Juicer has been my juicer of choice for years. Whether I'm making a glass of juice or a large batch of juice for my juice bar. These juicers are simple to use and so easy to clean. Champion juicers are masticating, cold-pressed juicers. 2 models are available, the Classic 2000 and the new Elite 4000. Besides juicing, both models can make frozen fruit, smoothies, nut butters, sauces, and even baby food. The Elite 4000 Champion Juicer also excels at juicing greens and wheatgrass. These juicers deserve to be called the world's finest. For more information, please visit my website at juicegirlpharmacy.com or championjuicer.com.
Welcome back to Live Better Longer. I'm your host, Bill Borton, here with Scott Inglis from Carnegie Investment Counsel. So Scott, before the break, we were talking about bonds and interest rates. So tell me, what do our consumers and our viewers and baby boomers need to know about bonds and interest rates?
Right. Well, we were talking about that idea that from 45 to 1980, we had a steep increase in rates, and that we've had a 35-year decline from 1980 to 2015-16.
Right.
Since then, rates went from 1.3% on the 10-year to 3.1% on the 10-year Treasury. Now, a lot of people think when interest rates move higher, that's bad for stocks, that's bad for the stock market. That's a bit of a misnomer. So we looked back and we looked at a study from 1950 to the present, during times when interest rates have been rising and interest rates have been falling. And the fact is that when the 10-year Treasury interest rate has been moving higher, stocks have actually performed on average 13.1% a year in the 12-month period ahead. In contrast, when interest rates have been falling, the 10-year Treasury has been falling, the return on the S&P 500 has been 12.4%. a year. So it's a bit counterintuitive and a bit counter to what most people think. They think interest rates are bad. Higher interest rates are bad. They're bad for stocks and they're bad for financial asset prices. But the reality is since early 2016, when interest rates were at a low of 1.3 until this year at 3.1, what's happened with the stock market? The stock market's done terrific. From the low in early 2016 to the high earlier this year, the stock market, the S&P 500, was actually up 50%, over 50%. And certainly since the election in late November 2016, the stocks have had a very strong performance, up 37% since the election.
Okay.
So this notion that higher bond yields and the Fed raising rates is bad for the market isn't necessarily true. In fact, as we were talking about earlier, Bill, it's a sign of economic strength. It's a sign that consumers and businesses can handle higher interest rates, something that wasn't the case early in the financial recovery from the financial crisis.
Okay, so again, individual bonds versus bond funds.
Oh, well, bond funds have a few problems with them. I'll point out three. Bond funds, Bill, don't hold the securities, the bonds, to maturity, and they're subject to investor outflows, which are two big problems that bond funds have. The third thing is, if you talk about a bond index fund, like the Vanguard Total Bond Market Index Fund as an example, it's one of the largest bond funds in the world. There's over $200 billion in assets in it. But large bond index funds, they put most of their assets, they put most of the bonds into securities of the biggest borrowers, because they're weighted according to the outstanding issuance of debt. So in effect, you end up as a bond fund owner owning a fund that isn't going to hold the bonds to maturity, is subject to other investor flows, and you're weighted towards the biggest debtors. So arguably the ones that are the least creditworthy borrowers in an index fund. Ironically, what's happened in 2017, while I said how well the stock market has done, only according to Morgan Stanley, only $25 billion in assets went into stock funds, while $400 billion in 2017 went into bond funds.
Now, why is that?
Well, we talked about the symmetric relationship from 1945 to 1980, and then from 1980 to 2015. Most people in their financial lifetimes from 1980 on have only experienced declining interest rates, and they really don't know how to navigate in an investment world where interest rates are consistently rising. And that's where moving away from bond funds and ETFs can have such a great value for the investor and for individual investors. And owning individual bonds are a far superior way to get exposure to the bond market, especially in a rising interest rate world.
Now, why is that?
Well, there's a few reasons. One is by staggering your maturities, so a 3-year, a 4-year, a 5-year, a 6-year bond, you have control over your exposure on the yield curve. So
That's called laddering.
Laddering,
Yeah.
It's called laddering, correct. And by holding to maturity, you eliminate two things: interest rate risk and your exposure to flows. So you're not a forced seller of the bond, and by holding it to maturity, you know when you buy it what your total return will be over the life of the bond. The same isn't true of a bond fund. The Vanguard Total Bond Market Index Fund, which we talked about earlier, just year to date is down 2.5%. So a decline of 2.5% in a bond fund, while the stock market has done what? It's up, close to 3% for the S&P year to date. So while people think of bond funds as safe and safe return, in fact, when interest rates are rising, bond funds can be a very bad place to be. In contrast, a laddered, staggered maturity portfolio of individual bonds, Bill, can deliver all the benefits of current income that you look to bond funds for, but they eliminate a lot of the negatives that you get when you invest in a bond fund.
Many of folks in my audience, Scott, are baby boomers, 1946 to 1964. Some are already retired, some are anticipating retirement. When you're that close to the retirement line on one side or the other, what should you be thinking about managing risk versus growth?
Well, we call that the retirement red zone, plus or minus 5 years around that retirement date. And there's no question that an investor or a baby boomer in that circumstance has to adjust their approach to risk taking. There's an increasing amount of uncertainty. In that switch from retirement to pre-retirement to post-retirement, what happens is the source of income has to switch from earnings and current earnings, which tend to have built-in inflation protection. Most people, when they're employed, have the benefit of at least a cost of living increase, even if it's a modest 2%. It's something that is protecting their purchasing power. And so as that transition from having built-in protection for purchasing power shifts and has to be replaced by portfolio income and other sources in retirement, the investment strategy has to change in conjunction with that, really to make sure not only that the baby boomer has enough wealth and earnings to preserve their purchasing power, but also as time marches on to protect that purchasing power from the ravages of inflation.
So growth becomes less important at that time, and protecting what you've got becomes more important. While as the older you get into retirement and the fewer years you theoretically have left to live, you can actually be more aggressive.
You can actually get more aggressive later in life, which is a bit of a counterintuitive thing. And a lot of people say that your exposure to stocks should be 100 minus your age. We find that in reality, as you live longer, and living longer is the goal, obviously, for a lot of the people watching this program, as you live longer, you actually have the capacity to take on more exposure to growth, and it becomes more necessary as your income sources dwindle from your pre-retirement years, and your portfolio needs to keep pace with rising healthcare costs, for example. And so there is, you're right, there is the potential for, once you get through that retirement red zone, that period of uncertainty when you're learning about how much retirement's going to cost for you, once you get past that period, there is the possibility of leaning into growth again in the later years of your portfolio.
Well, what I do, as you know, Scott, is risk management. And de-risking a portfolio through using insurance and annuity products to reduce the total reliance on the portfolio actually frees up folks like you to be able to be a little bit more creative and a little bit more long-term, because you're less concerned about healthcare costs, long-term care costs, or just plain living too long impacting the performance of the portfolio.
That's right, and of course, every situation, every person's situation is different. The days of the traditional defined benefit pension plan are dwindling. Some folks do have access to traditional pension income, which can provide that floor or level of security and allow for more growth in their managed portfolio. In the absence of that, there are a lot of tools that can be put in place that can give clients the assurance that their floor and basic, most important retirement expenses are met, and that frees up the portfolio to be more growth oriented, to pursue inflation protection strategies.
Good ideas. This is Bill Borton. We're going to take another break for a word from our sponsors. We'll be back more with Live Better Longer. Thank you.
When did you see the sign?
When I needed to jumpstart sales.
Build attendance for an event.
Help people find their way. Fast Signs designed new directional signage.
And got them back on track. Get started at fastsigns.com.
Welcome to Live Better Longer, the show for baby boomers who want to improve and even extend their retirement years. I'm your host, Bill Borton. On Live Better Longer, our viewers meet and learn from a wide variety of experts and thought leaders who share their knowledge on subjects ranging from portfolio management to nutrition management. From insurance, Social Security, and reverse mortgages, to annuities, Medicare, and Roth IRA conversions. Not just thought-provoking and actionable information, but why it's important to you. Tune in every Tuesday at 11 on RVN TV for reliable and unbiased information from experts in their field who are committed to helping you live better longer.
Is your business growing and now you need a new and bigger building? Has your organization outgrown their facility and now it's time to expand?
Do your hobbies require the need for more space?
If you're paying rent, but now you want the advantages of owning, the prospect of financing, construction, and on-time completion may seem out of your reach. General Steel Corporation has the answer.
A pre-engineered steel building from the General will not only look great and satisfy almost any need, but you'll save time and money. Our team will help you create your building and deliver it to your location. We offer design services to help you present your concept to board members, bankers, or for fundraising. And the General can even help with financing.
General Steel is a name you know, with quality backed by a 50-year structural warranty. Call today and find out how easy it is to have the building you want.
You may even save up to $20,000 with rebates. If you need space, you need the General.
Welcome back to Live Better Longer. I'm your host, Bill Borton, here with Scott Inglis from Carnegie Investment Council. Scott, before the break, we were talking about the transition from focusing on accumulating assets to providing income in retirement, or what's known as decumulation. And you have some thoughts on income security.
I do very much so. I think we were talking about that retirement red zone and success in retirement for your viewers. And you know, really there are three key factors for success. One is try and arrive at that retirement date with as little debt as possible. Mm-hmm. So if you're going to avoid the room, which we say is avoid the room running out of money, because that's everyone's concern in the end, is they want to make sure that they have enough money in retirement. Mm-hmm. One of the best ways to ensure that is to make sure that you arrive at retirement with as little debt as possible. The second thing is, we talked about already, how you manage that portfolio transition during that retirement red zone period is essential. And then the third thing is navigating the current environment. And by navigating the current environment, that is, know your risk tolerance, know your capacity for risk taking, but also know what the environment is offering. You know, what kinds of return are reasonable given the relative amount of risk that you're willing to take.
So that being said, Scott, what are your concerns about the markets now in 2018?
And Bill, I think the biggest threat to a successful retirement, not just in 2018, but beyond, and 2018 certainly highlights a lot of that, is behavior and people's behavioral decision making, behaving emotionally. In the current context, we've got a tremendous amount of noise from the media, and this is an election year. In 2018, there's going to be a lot of emotional triggers for people, both positive and negative, that will affect their decision making around finances. I like to point people to a Vanguard study that points out the value of emotional distance that comes from working with a professional advisor, either for professionally managing a portfolio or professionally putting in place a retirement income strategy through financial planning and other techniques. That is essential to preserving people's income in retirement, is avoiding large behavioral mistakes. Vanguard suggests that up to 3% a year, so for someone who had a $1 million nest egg, that's $30,000 a year, which over 10 years, of course, would be $300,000. It can be avoided in behavioral mistakes, 3% a year, through working with a professional advisor to avoid costly errors in retirement. So, you know, that's something, you know, that I like to point people towards, and especially in a year like this. So two of my concerns right now are, it's an election year, and that tends to bring out the best and the worst in people's emotions. I'll reference a quick anecdote here. I had clients that called the day after the 2016 election and wanted to sell everything. Everything in the moment based on their emotion. If they had done so, they would have missed out on a 30% return year. By contrast, we had clients show up and wanted to hand us $1 million check the week after the election and said, put it all to work. Now, both of those were driven by emotion and were out of context of the longer term planning that they should be thinking about. So especially in this year when the headlines, we wake up to tweet storms and the headlines grab our attention and cause us to have fear and excitement in either direction. I think it's very important to manage that this year. And stay invested, stay with your plan, stay with your long-term goals, regardless of election outcomes. The second thing is more related to economics, and that is dollar strength. So with interest rates increasing in the United States, especially relative to the rest of the world, it has caused the dollar to become stronger. And over half, almost half of S&P 500 earnings are outside the United States. So when those get translated back with a stronger dollar, they'll get translated back at a higher dollar rate, which means lower dollar earnings when the overseas earnings come back. That could put a little bit of a damper on the earnings outlook, but more importantly, in the past, in 2016, when we had that problem with oil prices, a strong dollar tends to be a threat to emerging market economies because it dampens. We're the largest consumer in the world. Rising import prices dampens demand for foreign goods. So we have to keep an eye on the dollar in 2018 and make sure that the strength of the dollar doesn't get in the way of all those other strong fundamentals that we talked about. Consumer confidence, the tax cuts, housing affordability. All those things are very positive domestic factors in place, but we've really got to keep an eye on what happens with the U.S. dollar in 2018.
So you mentioned, Scott, that it's a consumer economy. When people are thinking about investing in equities right now, what sectors do you think make the most sense?
Well, we certainly are positive about the economic outlook. So economically sensitive sectors are ones that we're emphasizing, particularly technology. But technology, consumer discretionary, financials, those are three sectors that we recommend people get exposure to. Avoid interest rate sensitive sectors like utilities, telecoms. Avoid areas that lack growth and exposure to the economic growth that we find strong. Consumer staples. So, positive on technology, consumer discretionary financials, light on consumer staples, utilities, and telecom.
Scott, we're going to have to wrap up. Before we go, if someone would like to speak to you, what's the best way to get in touch with you?
Well, I would direct them to our CarnegieInvest.com website, Bill, and reach out through our 800 number, send us an email, get in contact with me at Scott. It's SINGLIS at CarnegieInvest.com, which is also on the website, and we'd be happy to talk to any of your viewers about their plans.
Thank you, Scott. It's been great having you on the show again. Scott was my first guest back in October of last year when I began Live Better Longer. So I'm happy to have him back. Scott, thank you.
Thank you, Bill.
Next week at 11, another issue of Live Better Longer with Bill Borton on RVN TV. Until then, enjoy.